The importance of tip reporting to claim no tax on tips deduction. To take full advantage of the no tax on tips deduction, which came about with new U.S. tax laws, you must follow specific reporting procedures to qualify and gain the full tax benefit of this tax provision. This deduction allows eligible workers in tipped occupations to deduct up to $25,000 of qualified tips from their federal income tax each year through 2028. It is important to understand that this is an income tax deduction, not a payroll tax exemption. You and your employer are still required to pay Social Security and Medicare taxes on all tip income. To claim the benefit, you must report your tips to your employer, who is then required to separately account for them on your W-2, specifically Box 7 for Social Security tips, or a newly designated box for qualified tips starting in 2026. If you are self-employed or your employer does not report the tips, you must report them yourself using Form 4137, Social Security and Medicare tax on unreported tip income, to ensure they are recognized as qualified for the deduction. Effective documentation is the bedrock of a successful claim and serves as your primary defense in the event of an IRS inquiry. You should maintain a daily tip log, such as IRS Form 4070A, which records the date, the amount of cash tips received directly, the amount of credit card and debit card tips, and any tips paid out to other employees through tip sharing arrangements. Beyond a simple log, you should retain secondary evidence such as restaurant guest checks, point-of-sale receipts, or monthly summaries from payment apps like Venmo or PayPal if you receive digital tips. For the 2025 and 2026 tax years, keep all copies of Form 4070, the monthly report you give to your employer, as these will be vital if your W-2 does not accurately reflect your total tipped income. Digital records or scanned copies are highly recommended, as physical thermal receipts often fade over time, rendering them useless for long-term record-keeping. One of the most frequent mistakes is the failure to report tips to your employer on a timely basis, which can disqualify those earnings from the federal deduction. Under IRS rules, you must report tips to your employer by the 10th day of the month following the month the tips were received, provided they total $20 or more. Another common error is failing to distinguish between qualified tips, which are voluntary payments chosen by the customer, and service charges, which are mandatory fees added by the establishment. Mandatory service charges are generally treated as regular wages by the IRS and do not qualify for the no tax on tips deduction. To avoid these pitfalls, ensure you are communicating clearly with your payroll department about which portions of your income are voluntary gratuities and verifying that these categories are accurately marked on your pay stubs. Accuracy in filing is also compromised when taxpayers overlook the specific eligibility requirements regarding tipped occupations and income thresholds. The deduction is only available for occupations that customarily and regularly received tips before 2025, such as bartenders, servers, and hairstylists. It cannot be claimed by reclassifying regular salary as tips in a non-tipped profession. Additionally, the deduction begins to phase out if your modified adjusted gross income exceeds $150,000, $300,000 for joint filers. To avoid a surprise tax bill or a rejected deduction, use the Treasury Department's tipped occupation codes to verify your job's eligibility before filing. Using reputable tax software or a professional can help ensure you're not claiming the deduction if your income level or job type has crossed into the phase-out or exclusion zones. Finally, a major oversight is neglecting the unreported tip reporting process when an employer's records are incomplete. If your W-2 shows a lower tip amount than you actually earned and recorded in your daily logs, you must not simply enter the higher number on your tax return without the proper forms. You must file Form 4137 to account for the difference, which ensures you pay the necessary Social Security taxes while also making that extra income eligible for the $25,000 deduction. To prevent this, reconcile your personal tip log against your final pay stub of the year in December so you can resolve any discrepancies with your employer before they issue your official tax documents in January. We welcome you to subscribe to our YouTube channel for more informative videos on taxes, finances, and investments. Thank you.